So this gap, this new week opening gap, it has been taught by me multiple times throughout the years that this is like a real strong price magnet. The market's going to want to gravitate back to it if we're not trending. Okay. And this is the part where if you're watching and you don't have a notepad or your journaling is not being utilized here, you're wasting your time watching this, because these are things that repeat. If the market's going to be consolidating or not in a trending environment, the opening gap on Sunday, if you extend it through all the way through Friday, you're going to see many times the price will gravitate back to it. Sometimes it'll go into halfway. Sometimes it'll go completely through it. It'll act as real support and resistance. The way you expect classic support and resistance to work, like you see in the books, these two price levels and the middle of it. What is the middle? You just take your fib, apply it on the opening price on Sunday, and you apply it to the closing price on Friday. That range is extremely sensitive, especially with the low, the high, and the midpoint. So the midpoint level would be 41.40 and a quarter. And you can draw some distinctions the way you would want to do it. I'm just showing it like this is one way of doing it. Is that we can differentiate what it is. You can make them very bold. And I keep mine like a black color, which is indirectly, something standing out in my chart, whereas usually I'll have like a blue line or a red line for like liquidity pool. This way it's drawing a heavy distinction between what a level might be on a lower time frame. I know that big heavy thick black line is rooted on something higher time frame, and or in this case it's the new week opening gap. You can see how we've already traded up to it here. It bumped it here, failed to go here, went lower, worked it here, just fell short of it there. Tried several times here and failed right here. So we haven't really probed anything above meaningfully the consequent encroachment, which again, consequent encroachment is half of a gap or any inefficiency, such as this level is here. We haven't worked really anything up into this area here. So there's a little bit of price action that has not closed in or offered buy side here. So even if we do go lower, take out this low, which is in my mind likely this morning, we could go down here, reject, and make an attempt to go up here if we get that weakness in the dollar. So if the dollar does trade lower, that would offer an opportunity for the market to want to trade back up into this new week opening gap, which is these specific price levels. Now, think about what it is stated there. I'm not teaching supply and demand. I don't believe in supply and demand, unless we're talking about commodities, which are really directly linked to a real supply and demand factor, because it's a real market. Not to say that you can't make money in this market. It's not a real market, not in the same sense that a bushel of wheat or gold, that's something real. Okay, the value of a stock index is not the same as something that you can eat. This could theoretically go to zero. Highly unlikely, but it theoretically could go to zero. Gold's not going to zero. Wheat's not going to zero. Cattle, beef prices, pork, crude oil, it's not going to zero. So there's real supply and demand factors with those markets. But when we look at markets like this, in many ways I view them as synthetic. They don't have the same measure of supply and demand, but it is manipulated and engineered. So the interest is always constantly manipulated. So what I do and what I teach my students to do is look for areas in markets where the manipulation is obvious or it's expected. And then we look for setups that repeat using phenomenon based on markets trading to liquidity, buy side liquidity, which is above a high or relative equal highs. That can be an entry to a new trade, or it could be a closing target for an existing trade. Don't think that it's that, that is the only approach for your trade. It's a target only. No, I can use it as an entry too, as you'll learn this year as well. I want to focus primarily on what I taught last year, that model, the 2022 model. But I can't promise that I won't stray off topic when it doesn't materialize. So because I'm in front of you live, I want to get you thinking about things beyond that model. So that way, for those individuals, not that all of you should be, but for those individuals that are already outgrowing that model because you've now used it, you're making money with your funded account, maybe live funds, and you're learning, you want to do something more and broaden your horizons in terms of price action. I'll show and do more of that stuff this year. But also, it's just beneficial for you to just simply because I might not trade a specific price swing doesn't mean that I can't see it, or you may not steer away from it. It may be the very pattern that you're going to focus in on. So I'm trying to be the mentor that allows you to bring your own. I'm going to maximize this now. So all of this is going to disappear. And it's not important that it stays up. I just want to make sure I showed you how I did that compare. All right, so now think about what has happened here. We have a 5-minute chart. Now we have liquidity down here. Let me get this out of the way. Sorry. So at this low and just below it, I teach my students, we aim for that. I don't look at that as it's going to go down here and bounce. I don't ever look at it like that. I look at price like, who went long here? I don't know. You don't know. We don't care. Somebody went long. The market went higher. So below that low, classical technical analysis is going to do what? Preach that you have to put your stop loss rate at that low or just below it, right? So what kind of stop's going to be there? A sell stop. Which is why I teach that is sell side liquidity. Price rallies up, it breaks down. What just happened right here? Right below this low, it shifts. Market where? Bullish or bearish? Bearish. So what we do is we look inside this price leg here and we look for any inefficiency. So once this leg here has been broken on that candle, that one right there, that's where you enter with the expectation of finding the setup that I taught in the 2022 model. This is exactly what you would expect to see. Now, why is that? Because you're seeing, number one, buy side taken. See these relative equal highs over here? Above this area, anywhere in your price, anywhere in your chart, I don't care what market you trade, it doesn't matter. This is like a constant thing that repeats over and over and over again. Watch this volume imbalance in here, by the way, because it could see that and then drop down in below there. But buy side liquidity here, above old highs, when the market's dropping, like it does here. If anyone went short there, where would they place their stop? Theoretically, to protect themselves. The books teach us what? Put your stop loss at the high or just above it. So the market drops down, rallies from here, and all of this area here, that's absorbing and engaging all the buy side liquidity or buy stops that will be resting above these relative equal highs. So that's what's occurring here. So what I teach my students and how I internalize price, when I see that, I'm expecting price to do what? Show a willingness to want to go lower. Because it went up here for real orders. I don't need level 2. You don't need level 2. You don't need depth of market to see that. It's plain. Wherever there are smooth edges, like these relative equal highs like this, the market it's uncanny how it will go up there and make those smooth edges jagged. So it's all nice and smooth here, like a perfect ceiling, right? And then all of a sudden you see this smash running up, spend some time up here, and then breaks lower. This moment right here, when it takes out these lows on that candle, that is the market model that I gave you for 2022. Doesn't mean you get in. It means now you look at this price leg here. Go back through this price leg because this is the displacement price leg. This low has been taken out right there. So inside this entire run lower, you want to look at where there is an inefficiency or a fair value gap. That fair value gap is your entry point. You just don't chase it just because it went down below here. Many times I see a lot of YouTubers, they're breakout traders. You know, they might make money, but I promise if you spend a little bit of time, what I'm going to teach you this year, you will enter shorts when the market's going up. And it seems scary. It seems like I don't want to do that. That's terrifying. How do you know? Well, number one, you know because you practice it. You do it over and over and over again. And by doing it over and over and over again, it desensitizes you to, because in the beginning, you want to be correct. That's really, you didn't get into this business to be right, because if you wanted to be right, you would play board games and play chess. Okay, those types of things. I was right about these moves and these outcomes, and that was the reward for it. In the markets, you want to be profitable and control and manage risk. You don't want to do anything but that. That's the number one factor for why you're doing something. But in the beginning, that lure into the marketplace while you're doing it changes and morphs into, I want to be right. I don't want to be wrong. Because ego, pride, just, I guess, the inability to embrace uncertainty creates fear. And somehow we as humans encapsulate that one transaction, that one idea that in many ways is insignificant. One trade is insignificant. But in the beginning, you make that singular trade or a singular trade paramount. Like it's the only thing that defines you as a profitable trader. And that is unfortunately something that is normal. It happens to everyone. I went through it. Everyone else that's still trading, profitably, no matter how long they've been doing it, they can sit there and they're nodding their head right now listening to me. Like, yeah, that happens. Everybody goes through that. The problem is you want it to be black and white, perfect. You know when it only works and you know when it doesn't work. So therefore, you're thinking that there's a way for me and you and everyone else out there to never take the losing trade. And that doesn't exist. That does not exist. So you have to look at the probabilities of something repeating that we can look back in time and say, okay, it usually does this, it usually does that, and therefore I've seen 100 sample sizes of this particular thing happening under these circumstances, the things that lead up to it. And what does that mean? Well, as I mentioned, we had relative equal highs. The market runs up in here. We don't do anything. We're waiting. Then the market drops. It does so here. Do we do anything with it? No. The market rallies again. What does it do? It runs above the rejection block in here. It's in my YouTube channel. And then there's a displacement lower. So this willingness to break sharply below a swing low after taking buy side. This is how you frame high probability. High probability for a short means some measure of buy side has been taken. We see that here. Then you wait for what? Displacement. That means, in plain terms, you want to see the market drop sharply lower and take out a specific low. Here's a short-term low. It trades through it here. Once we have that, then we can go back through all this price leg here and look for inefficiencies. That means a specific fair value gap. Now, once you have that price leg identified, you want to go through all your time frames. 5, 4, 3, 2, 1. Right now, I'm showing you on a 5-minute chart. So we have this price leg from high to low, high to low. This is the low that was shown as a break in market structure, and not break, I shouldn't say it that way, a shift in market structure. So anything at this level or higher, we want to look at that as a potential what? Fair value gap. Now, this is the part that being mentored versus just watching one of my videos or listening to someone else try to take a series of lectures or a video of mine that may be an hour or so long, and they try to condense it to a 5-minute trainer. Learn ICT stuff in 5 minutes. You're never going to learn what I'm about to show you in those 5-minute trainer versions. Okay, I understand everybody wants to get clicks on their videos and such, but if you want to learn, there's a way of doing it correctly, and there's a way of just looking at cliff notes. It didn't work for you in school when you studied the cliff notes and you didn't get a high score. You have to read the book, right? Okay, so here's what it is. Inside this run from the midpoint of this leg higher and lower. Okay, that's the price leg that we're looking at. Why this price leg? Because it took out this short-term low on that candle. It's a shift in market structure, bearish, lower prices are expected. We do not look at any rally up as a sustainable run. Why? Because stops have already been taken above this high here. Then there's a shift in market structure below that low. That means that any rally after, establishing the midpoint here, once it goes above that, in my mind, I'm thinking we're only going up to go down. So algorithmically, the market will print and produce a premium market. A premium market is where you want to sell your long positions and as partials or enter your short positions. When the market's rallying, that's where you want to short. You don't want to sell in down candles. That's chasing price. When you see me doing my partials, or not my partial, when I'm pyramiding into a position, I'm selling short in the up candle. And then I'm adding more as the candles are going up into that move. I'm not fearful of that. When I first started, I was absolutely afraid of that. I was scared. I was afraid what I was buying was a rocket. And I didn't want to get stung. I didn't want to get hurt. More specifically, I didn't want to be wrong. I didn't care about the money. I didn't want to be wrong. I wanted to be right. And being right is not essential to profitability. It sounds like it's an impossibility because you can be right and lose money. You can be wrong and make money. So you have to do many times what seems like is the most proper way of doing it, most intuitive thing is most of the time not the correct thing to do in trading. When the market's been going down, everybody thinks, well, it's going down, so let me get short. They chase it. And I was a victim of that when I first started. So that's the reason why I teach the PD array matrix. So that way we can frame a price leg, as we're doing here, the high to that low. Why am I specifically aiming for this price leg? Why am I only looking at this one? And why am I looking at this one? Because this one here didn't do any kind of a short-term price run where it created a swing low like this one does here. It rallies up, and then it overlaps that entire run and breaks it there on that candle. Once that occurs, as soon as that happens, I'm waiting for price to make a turn and start going back up. Well, what happens here? ICT didn't go above the equilibrium price went here? No, because this level isn't the equilibrium until this low. So if we were looking at this here, did that trade meaningfully above the 50% level? No. And even if it poked its head above that, did it trade to a fair value gap that would be inside that price leg from here to here? No. So look closer. You have this price run down. We're waiting for price to go back above equilibrium, which is the 50% level on your fib. There's no mystery to it, okay? This is the only benefit of having a Fibonacci in my mind. That and how I use it for targeting. And I'll show you that stuff. And you've probably already seen many times me doing it in my live executions and managing the position and trailing the stop, looking for targets to be hit and such. But this run above equilibrium within this price leg here, that sets the stage Okay, now we are in a premium market, meaning this range is premium. It's, in other words, overbought. I don't need an indicator. You don't need an indicator to arrive at. From this point here to here, this is discount. As soon as we leave, and again, this is, again, not in the folks that try to teach my stuff. They don't know what they're doing. And I'm asking you, please stop trying to teach my stuff because you don't know what you're doing. You're not covering things that are most salient, and you're oblivious to the things that are necessary for certain things to be really in the marketplace. This discount, okay, in the red shaded area above this level here, that's a premium. Above it or at that level, they're your ideal shorts. As soon as you cross the midpoint of the discount level here, once we get through that, I did that by eyeball. That was pretty good, wasn't it? Once you get through that there, the highest form of profitable shorts, the highest probability short entries, they have now been exhausted. The only thing you want to be focusing on now is taking partials and trailing your stop. Yes, that's a diamond. You just simply can't just take every single trade and enter and enter and enter and enter. When do I stop taking partials or pyramiding? Something like this. Now, I'll build pyramiding entries all in this until we get through here. And then I stop taking pyramid entries. Go back and look at my examples and you'll see that's the truth. So when I wanted to learn how to pyramid and build my positions large, I learned it incorrectly from Ken Roberts' rag of a book, the world's most powerful money manual, of course. It's a long title for something that was useless, like toilet paper. But I guess toilet paper is useful, but use toilet paper, let's put it that way. The idea of looking for the best entry points, the highest probability, and how the market will respect those levels more so than others. See, once we leave the midpoint of that discount range of this price run here to here, and we're in the lower portion of it, we're entering that expansion phase. That expansion phase is likely to not offer very many, if at all, new high probability pyramid entries to add to a position. So there's a threshold at which I will no longer add to new existing positions. But while I'm in that premium area, within that price leg, within the market structure that I'm looking for, as I just outlined here, and again, you're going to want to watch this portion of the video several times, it gives you the highest degree of probability for delivery from your entry to your targets. And you don't want to chase the move and build in more position once it breaks through the threshold I just outlined here. Because to do so, number one, you're going to be worrying about trying to put on another position versus taking off some as it moves in your favor. It's crucial in the beginning for you to do those types of things. Now, for someone that's seasoned, they've been around for a long time, you know what you're doing, you know how to profit, you know how to look at targets, your targets are not unrealistic, and you can go to full terminus. That means your full target, where you aimed for when you first got on the trade. In the beginning, and this is who I'm talking to right now, when I'm doing these live streams and I'm talking to the students that are here listening, I'm not talking to the guy that's been doing it for 5 years and he's funded and he's got profitability. You can glean what you want to glean from what I'm teaching. But it's the folks that are brand new. They have no idea where to go. They have no idea what to do with this information, how to use it, how to frame the logic. What rules do you follow? What do I do? What do I don't do? That's what I'm trying to accomplish with these lectures and obviously with the live streams. So once the market starts to draw back up into this premium area, we have to go through our time frames and look for fair value gaps. So right away we have this low to high. Let's go back in with the fib. So we have to go into a fair value gap at or above equilibrium. So from this point on up, we can look for what? A fair value gap. Is this a fair value gap? Yes. What if you sold short there? Would it be profitable? Yes. Where would your stop need to be? Here it needs to be at the high. That's a lot. That's a lot of range. But I don't want to have a stop loss like that. Okay, but you're going to have to be more selective with your entries then. Now look closer. Inside this price leg here. This is why I'm not supply and demand also. What is this? What's that? What's the separation between this candle's close and this candle's opening? Volume imbalance. The volume imbalance has no body between two close and or opening prices. So it can be a volume imbalance between a higher close and a lower opening, or it could be a difference between a close with a higher opening. That's the difference between the two potential volume imbalances. The wicks overlap. See how it has a small little wick right here? Let me see if I can. How can I do that here? I know there's probably a shortcut to do this, and you guys are saying, if you would just do this, ICT. There's a small little wick here and a small little wick right here. Whenever I'm looking at price, I'm looking for those types of things because that's a signature. That's a little glitch in the matrix. Think of it like that. So if you take that and draw it through, because we cut through candles, Sam. We're not supply and demand around here. If you cut through all this drop as it's retracing back up, what's it reaching for? It is reaching for an imbalance in here. Yes, there's one here with this candle. There's one here between this candle's low and this candle's high. And then we have one here to here, specifically with that candle. Which one is better? Yes, you can enter here and have a stop loss up here. But look closer. In this delivery higher, when it ran higher, what is this last up close candle anyway? It's a bearish order block. Why is it a bearish order block? Because it has a fair value gap. Opening price on this candle is what? You're going to look right here. Opening price on this candle is 4130.00. Okay. What's the high on this candle here? You're looking right here. The high of that candle is 4130.00. You cannot improve on perfection. That's algorithmic. What's the high on the next candle here? 4130.00. Again, not one tick off, not one tick over, not one tick short. So if you had a series of fair value gaps, which one do you look to trade to or use your entry at? Look for the bearish order block. Look for a volume imbalance or a fair value gap on the other side of the drop. You extend it through. Again, we cut through candles. You can't. I'm not trying to be so dogmatic in the live streams, and I'm trying to control myself because I will literally go into a Twitter rant and just not be as productive as I'm trying to be. There's certain things you have to look for, and I can't teach you every possible scenario that's available in the future because it's better to see it live, explaining it live. Now you're looking at this saying, well, that's not live, it already happened. I understand that, but I'm showing you the logic that one would use to get to the delivery on this setup, which is exactly out of the 2022 model that was shown to you last year. So with that volume imbalance and the fact that it's above equilibrium on that price leg right here. So the first one you come to, you could go short there and your risk would be to that high. Trading at this one with the volume imbalance and the fair value gap, and now watch. What's the half of this up close candle? Remember what that was? What's the half of an order block? It's not consequent encouragement. Consequent encouragement is any inefficiency. A fair value gap, buy side imbalance, sell side inefficiency. Those are consequent encouragement midpoints. A candle, a range, a specific candle that's been delivered in price, the midpoint of that is mean threshold. Low to high is 41.31 and a half. So if you were taking this fair value gap, joining it with the volume imbalance, and it's a bearish order block, price should not do what? It should not trade above the midpoint of that up close candle. So your stop could be at 41.32. 41.32. So that means you have a 2-handle or 2-point stop loss entering within this volume imbalance, within this fair value gap. And if some of you are new, you have no idea that this stuff is repeating like this. And I walked you through an example, something like this in the stock indices last week. I said, I wanted to use a fair value gap for a resistance level. And it stopped dead in its tracks, just like this did here. And I executed on it, and I showed it to you. So it's not cherry picking. It's not looking at hindsight only. You have to study hindsight. Every trader that's making money right now, that's profitable, they learned by studying hindsight. You have to understand what the concept looks like. You have to identify it. And that way, by seeing it, like when you go out and you learn how to hunt and track your prey, you spend a lot of time looking at tracks. Oh, this is a bear, this is a elk, this is a deer. And that's the only way you can identify what it looks like, because you have to see it in the history. Where has it been shown before? But once you understand the basics of the pattern, the setups, the primary framework, then it must be studied on real-time data. And it doesn't mean studying by pushing a demo account or studying with a live account. You do not learn anything correctly by doing that. There's a step in between that everybody skips over because they're in a hurry to be profitable. Versus, I want to take my time and be systematic. I want to know that I'm doing what I'm supposed to be doing and avoiding the things and not being influenced emotionally and psychologically because of the money. Because as soon as you put a trade on, you're worrying about the P&L of that trade. You're not worrying about the price action. Your mind shifts from managing the risk and managing the trade versus, now I hope I don't lose. Is this thing going to turn around and go after my stop? And it may not even be close to your stop, but most of the time it will, because you're in a hurry to do what? Jam your stop loss up. And that's not what a profitable trader does. Profitable traders aren't in a hurry to race their stop loss to break even. They're not concerned about that. Why? Because they've been here before. They know that even if this trade fails, it's not going to end their career. It doesn't undo the efficacy of their model or their approach to trading. It just means that that was one human transaction that they made. They placed risk behind it, and it was wrong, and it didn't deliver a favorable outcome. But you can still learn from that. And it doesn't unsettle you as a profitable trader that you don't say, I'm going to change what I'm doing. I'm going to change my approach to trading because I had a losing trade. Now, in the beginning, that's exactly what you're going to want to do. As soon as you try to learn from me or learn from someone else and you suffer a losing trade, the first thing you're thinking is, okay, this doesn't work. Let me go to something else. And I did that. I did that for years. And I had a winning model, but I kept tinkering around with it until I realized I was holding myself back. So that's how we go through the process of looking for the right fair value gap. Now, if there's no volume imbalance, or if there's no fair value gap here on the other side of the displacement leg, then I'll use the first fair value gap above the equilibrium. And then there it is. Now, another version of this would be using this. And I usually do this if I'm going to be building a large position. Like if I know I'm going to be building a large pyramided position up, I'll use this run up where it takes, right before it drops down, and takes a shift in market structure. So this is the displacement leg. Okay. This leg here, you split that in half. You would use any fair value gap, any fair value gap at this level. And here's your sell side liquidity we just talked about there. Let me finish this thought here, and then I'm going to talk about this volume imbalance I mentioned. This leg here to here, if we had no volume imbalance, if that wasn't there, I would take this low to that high, the equilibrium there, drag that through. This would be the fair value gap at that moment. So then I would be doing this. Again, this is assuming that there's no volume imbalance. My entry would be here and framed on this fair value gap there. Show me how to pick the right fair value gap. I just did. Did you write it down? Did you record it in your log? Did you journal it? No. You're watching it like Netflix, and you're going to never learn. So there's the logic. Okay? And there's the sell side. Now let me take your attention right back down into here, because I told you, watch this volume imbalance. You know, one of those cherry picking events. If you go over here, the separation between the candle's close and the candle's opening, you want to get real used to doing that in your charts. When you see that, your eye's going to jump to it. Do you see it here? See that right there? That's a volume imbalance. That's a glitch in the matrix. Okay? They're coded. They're there for a reason. Right there. See it? Just like it was here. And there's one here. And there's one right there. So when I look at price, my eyes jump to fair value gaps, swing highs, swing lows, volume imbalances. That's just where my eye goes. Okay. Here, think about what I was talking about before we drop down into the sell side. I said, watch this when it was trading up until here. So watch this volume imbalance. From this point here to that low, what is that? It's a PD array. It's an area where you expect price to react. React how? I framed all this here, but before I went on all the business up here, I said, watch that low. I believe we're going down below that. Now, I already know some of you skeptics in the audience are sitting here thinking, well, big deal. You know, it was this big run. I have hundreds of trades where I'm doing 100 handles or more. You can use the same logic to do those trades too. I am teaching you this year how to do a 5-handle run as a starting point. That is not to say that your entire career must only be on the basis of a 5-handle price move. It's to get someone that has never traded a low-hanging fruit objective. And I don't think there's anything wrong with that. Because if anybody in here that's an educator or teacher, they have a first threshold objective, something that they teach their students to aim for. I'm just electing to say 5 handles in the S&P market when you're paper trading and you're demo trading and you're tape reading. If you're looking for that, number one, if that's all you ever get to be consistent with, that's enough. It's absolutely enough. You can take that same little cookie cutter approach of 5 handles and put money management behind that. Money management behind something that is effective could produce many, many 5-handle moves over and over and over again. And it compounds, and you use the power of compound interest to do the heavy lifting through money management. You're not risking more. You would be, I guess, risking more comparatively from where you first started as your equity base. When you first start trading versus 5 years into trading, your risk isn't any larger percentage-wise. It's a fixed rate of percentage risk that increases monetarily, but never percentage-wise. So the heavy lifting is done by money management, not the bigger positions coming in. I can do that. I can do heavy-handed trades. But a learning student, first introduction to trading, first introduction to what I'm trying to teach, it would not be efficient for me as a mentor to try to waste my time trying to build you up to try to do these big heavy-handed trades in the beginning when you don't even know how to read price. So the way you learn how to read price and you feel rewarded, because it's more frequent that you'll see a 5-handle move than a 100-handle move. There's many 5-handle runs intraday versus how many 100-handle runs is happening intraday in one sustained run. It's not happening that often, right? So by framing the logic like this is where the stops are. What kind of stops? They're sell stops, so that makes it sell side liquidity. The market's going down up here, so where would it go? Down to here. Why? Because smart money and the algorithms that are in the marketplace, they engage these levels here. So what's above that? Buy side liquidity. In short, it's what? Buy stops. So what happens is the buy stops get tripped in here. Smart money, traders like myself and who I'm teaching my students to be, they will accumulate short positions against these buy stops with the expectation that they will ride price lower to this low. Why is that advantageous? Because below this low is sell side liquidity for anyone that has been long here and rode it up. I'm not saying that there aren't traders up here trading without a stop loss or trailing their stop loss up tight and had been already knocked out. That's not what I'm saying. Algorithmically, the market will remember and refer back to that low. It does not know how many stops are actually below the low. It doesn't need to know that. It just needs to reprice at that level. Then the people that are in the marketplace, quote unquote smart money, the composite man, they will use that liquidity as a counter to their shorting against the buy stops up here. So basically it's the game of tag. Tag, you're it. Buy stops are it. Okay, so now who's next? Sell side. Tag, you're it. Down here. So in essence, smart money sells to buy stops with the expectation that they're going to run lower in price and then buy sell stops. Now, you don't learn that in books. You think buy down here support, sell up here resistance. And I take my students' understanding about the marketplace and turn it upside down. Because inside the upside down is the clarity that you're looking for. The frustration is immediately removed. So now let's go back. The volume imbalance I mentioned live before it actually delivered to you. Inside this area, if we hadn't already moved so far away here, I would use as an entry. Why wouldn't you take that as an entry? If you knew and you said it was a volume imbalance cycle, you said there was a sell side liquidity, you said it was going to likely go down there, why didn't you take this as a trade? Why wouldn't I take that as a trade? Because of what I've outlined up here in reference to the premium and discount range. Once we leave, if we're bearish, once we break through the midpoint of discount, I cannot take another new entry. You can. I'm not. I'm managing now. I'm managing my core position. That's it. It's over. This becomes a point of interest where I'm going to see the trade be managed with it. I am not going to put my stop loss below that volume imbalance. I'm not going to trail it down there. If I see that volume imbalance, as I mentioned real time, I said, watch that area. My stock could be above this high. It could be at the middle of this up close candle mean threshold because it shouldn't go there. Why? Because I'm expecting this volume imbalance to keep price from wanting to rally all that. Why? Why would I expect that? You see this opening here? We rally up. We drop down. All of this range between from the low and the high, that range has already been delivered to this low. So 41.18. The next candle here, we open, we drop down, and we roll right back over top of 41.18. So we had 2 times between this candle's high and this candle's low. This entire range you're learning today. School is in session with ICT. So inside that range, this is now balanced because we've had delivery to the downside. We came off of it. We went down through it again, and then we left what? A volume imbalance. So it's highly, highly unlikely that the market's going to do what? Think. What do you see in here? I've been recently teaching a lot about it. That low to that high. What's that price? It's consequent encroachment. Wait a minute. You said that's for gaps and fair value gaps. Yes. A wick is a gap. To an algorithm, they view a wick as a gap. Midpoint of that is consequent encroachment. What price is that? 41.19 and a quarter. So my stop would have to be above that. Trusting that it would not go above that. That's stop management. That's how you understand what you're looking for.